Thank you all for sticking around for the last of our paper sessions, and it's going to be a fun one. So I'm Larry Schmidt. I'm also from MIT Sloan, and I'm thrilled to invite our esteemed authors and discussants. So we're going to start with Edna, who's going to tell us about in-the-money options.
Thank you. Thank you very much. I don't know if you can help me with the slides, please. Thank you. So first of all, thank you for including this paper in the conference. This is my job market paper, and I'm in the market this year. So I'm welcome to receive any of the comments. And the paper, it's called In the Money. It's low leverage option betting. And I'm going to start talking about specifically retail investors who have been increasingly drawn to the options market influenced by social networks. According to Brigham, they represent now 48% of the total volume of the option market. And because of this, they have raised concerns about the motivations of these investors to trade in the options market, and therefore the consequences that they could have trading these complex derivatives. What do we know about these motivations? We know that retail investors are often associated with gambling motivations, and therefore options are an asset that are very appealing to them because of, specifically to investors that have skewness preferences, because options have this leverage and also non-linear payoffs that makes them generate lottery-like returns. However, in the recent literature about option trading, retail option trading, they have found mixed results about this skewness preference on retail investors. So for example, Brigham found that only 24% of the retail option trading is in out-of-the-money options. And Boguslavsky and Murayev found that actually they found no evidence of this positive dollar profit skewness. And on the other hand, also De Silva found that retail options trading is more driven by attention than actually by these skewness preferences or lottery preferences. So because of this, in my paper, I examined the motivations of retail investors on the options markets beyond the focus of these out-of-the-money skewness preferences. And what I do is specifically is analyze the options trading of small customers in the equity market, equity options, and of stocks with high retail attention on social media. And what I found is that retail investors trade not only out-of-the-money options, but they actually trade low leverage in the money options. With this, I'm providing a new insights of the debate of whether retail investors are actually trading in the options market as a gambling as a gambling behavior, and I'm also adding to this literature about options, specifically highlighting the importance of in-the-money options, which are low-leverage options that have been an underexplored segment of the options market. And in fact, I believe that this paper is one of the first ones to actually empirically study these low-leverage options. So specifically, what I found is that for stocks with high retail attention on social media, there's a high dollar volume of in-the-money options. This is actually higher than out-of-the-money options, and it's particularly concentrated on call options of short maturity and large capitalization stocks. Why are the motives of these investors to trade in the money options? Well, according to social media, I found that these investors favor in the money options because they perceive that they have a higher probability of actually having a payoff, although it could be just like a smaller return, but if they do more like this consistently, they will actually get profits from it. Unfortunately, when I look at the performance of these investors, ITM investors, I found that they actually lose. And in contrast with the out-of-the-money options, which has been the focus of the literature, I found that they perceived out-of-the-money options. I know that they're cheaper and they have also higher expected returns, but they perceive it to have a very low probability to actually be exercised and therefore having a profit to trade by trading them. And finally, I'm providing a simple model that suggests an optimal strategy for investing in the money options, which is buying call in the money options of short maturity options and large stocks, and low volatility stocks. So I'm going to skip the contribution and I go directly to the data because of the time. So for this paper, I aggregate the option contracts of 6 different exchanges. In total, I'm covering 70% of all the equity options market. Just to have a comparison here, I have the plot of the exchange coverage of each of one of these exchanges. And to compare to other studies that they have used this data, most of them they use like 1 to maybe 2 exchanges. And also to show you how big this database, I have here like how many observations I have, which I have like more than 1 billion, and how like the coverage of the stocks, which are around 3,000 stocks per year. So this is a very, very comprehensive option database. Another thing that I have is like other characteristics of my data is that I can see if there's a call, if it's a put, the time of execution, the time of maturity. And one very helpful feature that I'm going to use for my analysis is that I can see the identification of the user that actually generates this option. So I have customers, professional firms, and broker-dealers. And I'm going to take a look for the small customers, which are all the customers that buy every trade less than 100 contracts per trade. And I will define this as a small customers through my entire analysis and through my presentation. I know specifically the direction of this option contract, and also I have the strike price, which is which I will use to determine the level of moneyness of every option contract. I also use social media data. I use data from StockTweets, which is one of the most popular social networks among retail investors and has a very wide coverage of stocks. Okay, I'm going to start to look at the trade volume of these options. Here I'm plotting the average trade volume of an average stock by different level of moneyness. And on the left-hand side, it's call options. On the right-hand side, it's for put options. So what I observed here is that out of the money options, which are the yellow ones, which are the yellow bars, actually dominate the trading activity in number of contracts. However, when I look at this at the dollar volume instead of the trade volume, this trend reverses. So in here, the purple one, which are in the money options, they surpass the dollar volume of out of the money options. And this is very important because we know, like from this plot, that they have a high economic significance, showing that in dollar terms, the highest dollar invested are in these in the money options rather than in out of the money options. So another thing that I do is that if I aggregate this, indeed, dollar volume according to the level of in the money, out of the money, and at the money. For small customers, I see that in average, they are way, way higher than out of the money and in the money. If I aggregate them, if I aggregate them, like if I take the total dollar volume, they represent around 42% of the total volume traded in the equity options market. And another important thing is that if I compare it to professionals and firms, they just represent around 20%. So this is something very characteristic of small customers. And I do the same for put options, and I observe similar results, but in a lower extent. So now going to the option, like how the dollar volume behaves around, how it correlates with social media data. Here what I'm plotting is the abnormal option dollar volume of small customers around days where there's a high activity of a stock in StockTweets. And what I found is that on day 0, which is this abnormal activity, then I noticed there's a high, the dollar volume of in the money and out of the money increases, both for calls and puts, but specifically for calls, this is greater for in the money options. What I wanted to show you next is that actually this difference is significant. So what I'm going to do is that I'm going to take the difference between the dollar volume of the in the money versus the out of the money and calculate a similar abnormal measure. And I'm going to regress it. And I'm going to regress it to also an abnormal measure of number of posts of StockTweets of that specific stock for that option. And I'm going to control for another variables which are abnormal news on sources, on classical sources. I'm going to control also for past returns and past volatility of the stock. I'm going to take into account fixed and date effects stock fixed and data fixed. And what I'm showing you here is that for small customers, I observe a positive and significant coefficient, suggesting that there's more dollar volume of in-the-money options than from out-of-the-money options when there's a higher increase of this retail attention on social media. And this is particularly for small customers, because if I look at professionals and firms of the options they trade, I actually see that they have an opposite sign, suggesting that they trade more out of the money than in the money. And also just by comparison in terms of the level of coefficient, the coefficient is really, really small. So they react more highly to retail attention, these small customers' options. Another thing that I look is at how it's it's the maturity. So for buckets of maturity, I observed that this abnormal volume of the difference between in the money and out of the money is higher for short maturity options, specifically of less than 1 week. And what I'm going to show you next is basically what are the motivations of this what are the motivation of these retail investors? So one of the motivations that I found is that these retail traders are using these options to access high price stocks. And this is something that has been shown already in previous research. However, here in my paper, I'm showing how it differs from level of moneyness. So for example, here, I'm calculating the daily average of this difference between the dollar volume of in the money versus out of the money, and I'm sorting the stocks according to this variable. And the ones that have the highest difference are, if you see this on the left table, are big stocks, technological stock, and also prices stocks. Whereas for the ones that are in the bottom, this suggests that are more out of the money than in the money, I will observe a more heterogeneity in the size of the stock. And one of the things that I wanted to show you is that here we have the AMC, GME, meme stocks that are very popular among these retail investors. Another motive that I found, and I think this is very interesting, is that here I'm showing you some of the posts that I found on StockTwits of how retail investors say why they prefer in the money versus an out of the money. And what I discover is that they have this perception that they have a higher probability of a payoff, although they will receive smaller but consistent profits. Whereas for an out of the money options, they see that they have a very lower probability of payoff, more like a lottery ticket. If this is true, when I saw this, I was really intrigued. So then I went to look at the data again, and what I'm showing you here is the daily returns of the of short maturity call options traded by small customers for short maturity and for long maturity. So for short maturity, I want to bring your attention to the difference between the distribution of these returns of out of the money versus in the money. For out of the money, they have heavier tails, they're also less skewed. And in fact, if I calculate the mean of these daily returns of option contracts, indeed, the mean is higher for an out of the money, but the median, it's actually higher for in the money. So they indeed perceive that they have higher returns for in the money because they have it with more probability. So then another thing that I ask is, do they actually profit from this? Is this perception really true? So what I do is that I calculate the performance of these option contracts, and I'm not just going to take the order imbalance, but because I have this amazing data, I'm going to take the total net exposure, which is the net open interest for each option contract, and I'm going to calculate a performance measure using this net exposure. I'm going to regress this performance measure from a horizon of 5 days to dummy variables that determine if it's the stock, it's high attention in StockTwits, which is in the top decile, or if the stock is low attention on StockTwits, which will belong on the bottom decile. And what I found is that the stocks that have high attention on StockTwits, they observe bad performance for in the money options. And well, it also happens that they perform bad in other options, but in the money, it's actually a bit higher. So next and finally, I wanted to, So one of the things that this suggests is actually they're using these low leverage options rather than just as an investment, but also to gambling. And because of this, I'm gonna further show at the end just an optimal investment for trading in the money options based on a model that is Kelly criterion, which calculates the optimal fractions of wealth to invest in a bet, and it maximizes the expected value of the logarithm of wealth, taking into account you have sequential bets. And they have this model has a binary uncertainty just to win or lose, which actually aligns very good with gambling preferences of investors. And as a fun fact, I also observed that they talked about this Kelly criterion in the post that I found on StockTwits. So what I found here is that I calculate this optimal fraction to invest it in the money options, and what I do is that I use the Black-Scholes formula for the options, and I found this negative relationship between the optimal investments in the money options and the volatility of the stock and the maturity of the option. So basically suggesting that there should be an optimal allocation for in the money options for short maturity and low volatility stocks, which actually this helped me to understand why I observed performance, like bad performance in the previous slides that I showed you, because in the money dollar volume increases on periods where there's high retail attention, and these periods of retail attention actually coincides with events with elevated stock volatility, and this leads to the underperformance. So overall, my paper, it's beyond trading out of the money options, which we think as lottery tickets. I'm showing that retail investors also engage in low leverage options, and because they perceived it as a higher probability to have smaller returns, which actually sheds light to like maybe a different way of what we think that investors are gambling. Rather than just a skewness preference or lottery, I'm showing another way to gambling. Oh, thanks. And just to wrap up, these findings opens avenues for future research about gambling tendencies of investors, and also sheds light to this underexplored segment of options, which are in the money options. Thank you very much.
All right, next we're gonna have Jason telling us a bit about actual, very clearly gambling on sporting events. So looking forward to it.
Well, thank you to the organizers for putting this paper on the program. Two of my co-authors, Justin and Kevin, both from Kansas, are here in the audience today. We would love your feedback, so if you'd like to talk about sports betting during lunch, come find one of the three of us. If you consume sports at all, you undoubtedly have seen advertisements like this. You are aware that sports betting has become a huge thing over the last several years. And in fact, the total size of sports bets last year were about $120 billion, which has generated almost $11 billion of revenue for these sports betting companies. And so this has grown into a very huge industry. Our question is really, well, how has the growth of this sports betting industry affected household financial health? So on the one hand, maybe it hasn't done anything at all. So if you look at DraftKings, for example, and you take what they say literally, they ask you to practice responsible gaming, in particular to treat this as entertainment, and to note that gaming shouldn't be viewed as a pathway to financial success. Well, if households do that, maybe sports betting is just another entertainment expense, and it doesn't really affect financial health in any meaningful way. But what if betting crowds out long-term savings? Well, why would this happen? Well, let me take you to Reddit. So Bet Baby Shark on Reddit 3 years ago asked, well, is sports wagers, is that the same as stock investments? And some of the replies, I always thought they were basically the same. Stock market's just gambling, right? But sports betting is easier to understand. Okay. A confused shoe. I treat sports betting as a long-term investment. It's the number one thing I do. It serves both practical purposes, accumulating wealth, and entertainment as well. And then my favorite, Bet Baby Shark's reply here. Well, Warren Buffett says invest in things you know and you're passionate about. And for me, that's sports. So of course it's an investment. Well, if people are treating sports gambling as investment, that might have negative implications for their financial health. And so that's exactly what we're going to look at today. So in this paper, we'll use bank and credit card transaction data from about 230,000 households. So for these 200,000 plus households, we see every transaction they make, either from their bank account, so think checking and savings accounts, or from their credit cards. That's going to allow us to identify not only sports betting, so we'll see when you deposit money to, say, DraftKings or FanDuel or related betting apps, but we'll also see all of your spending. We'll see when you deposit money to your brokerage account, your Charles Schwab's of the world. We'll see when you spend and so on. So using this data, I'll tell you about the characteristics of sports bettors. I'll show you that $1 of sports betting leads to just about $1 reduction in net investments to equity brokerages. Those effects are going to be stronger, about 3 times bigger for financially constrained households. And for these constrained households, they're going to run up their credit card debt. They're going to more frequently overdraw their bank accounts. Their financial health is just going to deteriorate in a way that we might be concerned about. All right, so who are the bettors? Well, it turns out when you compare bettors to non-bettors, they look very similar in terms of income, investment, debt. So they're not really strange in those respects. But if you look at previous risk-taking experience, did you ever play online poker? Have you bought lottery tickets? Have you bought crypto? We see that bettors are much more likely to have already been risk takers. About 4 times more likely to have ever played poker or bought lottery tickets, about twice as likely to have ever purchased crypto or to have overdrawn their bank accounts in the past. So the bettors are already a risk-taking population. As sort of an aside, we see that bettors are much more likely to have received child tax credits during the COVID stimulus, which suggests they're much more likely to be parents of minor-aged children. So we're not just talking about college age or recent college graduates here when we talk about the sports betting population. All right, the betting behavior is highly skewed. There's a small fraction of the bettors who are doing most of the betting. If we look at the top tercile, on average, they're depositing about $300 per quarter to one of these sports betting apps. Or in other words, they're betting about 1.7% of their income. So the numbers here are reasonably large. This behavior is pretty persistent. So across our sample, conditional on betting, about 70% of those bettors deposit money to one of these sports apps at least 3 times. So this isn't just a one, let's try it and be done kind of thing. And if you look at the probability of continuing to make bets, after you make that first bet, it hovers at about 50% for the next 3 years. So it's pretty persistent that people keep depositing money over time. That leads to behavior where people ramp up their exposure over time. So this chart shows you the amount of money that a household deposits to one of these sports betting apps as a fraction of their initial deposit. And so you see, I make an initial deposit, and then I make bigger and bigger deposits over time. By 3 years after first making a deposit, I'm making quarterly deposits that are about 8 times as big as the first quarter I deposited money. All right, well, are constrained households any different in this behavior? If we look just in the aggregate, so this is looking at your betting deposits, the amount of money you deposit to one of these online sports betting apps as a fraction of your income. Well, this is going up over time, not surprisingly, as betting becomes more popular and legal in more and more areas, we see more betting exposure. But you see that it's rising fastest for low-income households. If we dive into this in a little more depth, here I'm splitting households into what I'll call constrained households. These are households with below median savings flows, and unconstrained households, above sample median savings flows. A few things that jump out here from the data. Well, if you look at the percentage of your income that households are betting, depositing to these sports betting apps, it's about twice as big for the constrained households relative to the unconstrained households. If you focus just on the constrained households, you see the probability of ever overdrawing is more than twice as large for those bettors as those non-bettors. So this isn't just about being constrained, and of course constrained households overdraw their accounts more, but conditional on being constrained, the betting population runs into financial difficulties much more frequently than the non-betting population. Now, of course, this may or may not be causal, and so we want to try and identify the causal effect of beginning to bet on sports. All right, so to do that, we'll take advantage of the institutional details here. So over the last 5 years or so, there's been a staggered rollout of online sports betting. Our sample will go until the fall of 2023, and as of that point, there were 26 states plus Washington, D.C. that had legalized sports betting. And you can see it just sort of rolls out over time. So we have variation in the timing. It turns out that this is relatively idiosyncratic. So if we try to predict what leads states to legalize betting, the local economic conditions, for example, do not seem to predict this choice. And so that's going to be helpful for our identification. If you look at this graphically, the states in blue here are the states that have legalized online sports betting. They're the ones that we're going to be using in our sample. The orange will not play a role in what I show you today. The orange states have legalized in-person betting, say in a casino, for example, but not online betting. All right, so effectively, we'll compare states that have legalized this online betting, these blue states, to states that have not legalized betting, the clear states here. So this is just a typical difference in difference, where the end result of this difference in difference will be to compare, say, a household in Massachusetts where gambling was legalized, online gambling was legalized last year, to, say, a household in California where online sports betting is illegal. Let's take that household in Massachusetts, look at their behavior before and after the legalization of betting, and compare it to that household in California before and after the legalization of betting in Massachusetts. And if we find a difference, it will suggest that there's something going on that's a result of legalizing sports betting. So we'll think of the first stage outcome here as being, does the legalization of betting lead to more betting itself, more deposits to sports betting apps? That should be a trivial yes, but we'll want to demonstrate it. And then the more important outcomes, we'll think of sort of a second stage outcome, which is, do we see effects on other household financial choices, investments, other risk-taking, other consumption behavior, and so on. All right, now for the academics in the room, we're well aware of the problems, the econometric problems with a staggered difference in difference. The charts I'll show you today are going to use the newest techniques to deal with the problems in staggered difference in difference. We also do that in the appendix, so we're estimating things here as well as we possibly can in this setting. All right, so here's the results for first looking at deposits of sports betting apps. Not surprisingly, when you legalize sports betting, people start betting. And importantly, what sort of this red line in the periods before legalization means is there weren't any differences in states that will legalize betting and states that will not legalize betting before betting is legalized. This is trivial. When betting is illegal, it's hard to bet. And in fact, you can't really do it through the apps themselves. We can estimate this numerically in a regression. What you see here in column 1 in the blue is that legalization causes betting to go up by $25 per quarter. That's in the state as a whole, not conditional on gambling. So if you condition on gambling, that represents about $180 per quarter for those gamblers in the state where it is now legal. And if you do this as a fraction of your income in particular, you see that the constrained households will measure 2 ways, both with low savings as well as with households that have overdrawn their bank accounts in the recent past. You see that constrained households bet a higher fraction of their income than unconstrained households do. All right, so what's the effect of all of this on their net investment behavior? You can see that, again, the legalization of sports betting leads to a decline in investments. Now, investments here are deposits to brokerages. So think Charles Schwab, Robinhood, and so on. The decline is about $53 per quarter. You might want to know, well, what's the effect of $1 of betting? And the framework I've set up here isn't well suited to estimate that. And moreover, the framework I've set up here doesn't allow me to control for within-state time trends. If you think something different happened in Massachusetts right around the time period that sports betting was legalized relative to what was going on in California, the framework I've set up so far can't deal with that easily. So to overcome this, we'll introduce a different two-stage least squares approach where we want to instrument or predict betting with a measure of how male-centric the spending of the household is. We don't see demographics in our data, unfortunately, but we can see where you spend your money, and some households spend their money in places that are pretty male-focused relative to other households. We'll use that as a way to predict, are you a bettor? It's known that sports betting is about 75% male, so this is a pretty relevant instrument. It's also going to allow us to compare within states, so we'll be able to control for within state time trends, as well as for sort of male household time trends. So the idea here is that as long as male household investment doesn't change around the time a state happens to legalize sports betting, relative to the investment behavior of everyone else that's not a male-focused household in that state, as well as relative to all the male-focused households all over the US, as long as those things are true, we can identify the causal effect of what's going on with a dollar of betting. So it's a pretty nice framework. It allows us to estimate this effect of a dollar of betting, and it's about $1 reduction in investments. That's overall, though. If we do this just for the constrained households, it's about $3 of a reduction in investments. All right, now, from our previous paper, we saw that some investment is actually kind of gambling-like behavior. Can I tell you that this investment is actually real investment and not gambling? Well, not really, because I don't see what happens inside of the brokerage accounts. But what I can tell you is this isn't driven by Robinhood. Robinhood investment falls, but it makes up a small fraction of the total fall. I can also tell you that we see reductions in robo-advisor funds, which are pure ETFs, which has to be long-term investments. But on net, most of this is driven by reductions in sort of more traditional-like brokers, such as Charles Schwab. All right, what happens to your broader financial health? Well, given that constrained households are most exposed, both in terms of their income and the reaction to investments, it's not a surprise that we see the financial health plummet for constrained households. Their credit card debt increases, their available credit decreases, they pay off less of their credit card bill each month. They overdraft in the future more frequently. The financial health just takes a dive. All right, so I've shown you that the legalization of sports betting has far-reaching consequences for household financial health. This increases financial vulnerability in states that legalize sports betting. And that suggests that there are potential benefits for a more nuanced approach to the regulation of sports betting. Of course, state governments love the increased tax revenue that comes from betting. And of course, many people get a lot of utility out of being able to bet on sports. But our paper argues that policymakers ought to consider the financial harm that might also accrue to at least some set of households when gambling is legal, and that we could take a better approach at regulating that. Our paper does not speak to how you might do that, but if you want to speculate a little bit, some things that might help would be, say, for example, adding frictions, such as requiring bets to be made in person rather than letting you do it anytime, day or night from your couch on your phone, or improving transparency in, say, bet pricing to allow households to potentially make some better choices. Thank you.
All right, thank you, Jason. Next, we're going to have, as before, we're going to have two discussants. So our first will be Ray.
Right. Awesome. So thank you so much for having me. It's wonderful to be here. I had a great time spending a year as a postdoc at the Golub Center. And it's kind of lovely to be back with all of you folks here. So I really enjoyed discussing both of these papers. It was kind of a really fun set of phenomenon and thinking about gambling and options trading. So I'm going to try to zoom out a little bit and think about how this fits into some of the broader societal trends that we're thinking about, as well as kind of a few comments on the papers themselves. So I'll start with Edna's paper. So I guess if we want to get the slides back up there. Yeah, all right, I'll keep going. But so let me just kind of start with a few kind of big picture trends that'll potentially kind of like help contextualize the results that Edna's showing here. And so all of these numbers, to start with, are going to be from the JP Morgan Chase Institute that's looking at outflows to kind of these retail brokerages. And so the share of young investors basically spiked during the pandemic and has remained quite elevated. So this kind of yellow line at the bottom is going to show the 2010 to 2015 ratio. And you can see that's kind of hit a much higher new steady state. This is largely driven by kind of male retail investors. So the male share of retail investors has increased a ton over that same period. So you can see kind of the mirrored trend there. And the biggest shifts here have been among Black and Hispanic kind of retail investors. So that's kind of driving a huge increase in the kind of retail investment participation that we're seeing. And simultaneously, we've seen a huge rise in these kind of short-dated retail options. And so retail options trading, the share of those that are in kind of these short-dated options has increased from around 8% to something like 26% over the last 5 years or so. And so what Edna looks at is basically this puzzle. So it's like, why are there so many in the money options contracts? Like this is pretty far from my kind of like core area of research, but I think the usual justification for options are things like leverage and hedging, speculation, trading costs, or kind of outright gambling. And for basically all of these purposes, like out of the money options are going to be kind of the natural place to turn for that. But as Edna documents, there's been a huge increase in the money options, and they're a huge dollar share of the actual kind of options being traded here. And so Edna's insight is that basically you can kind of model this investment approach using the Kelly criterion, and that is going to basically present this clear strategy for like when you would want to use an in-the-money option versus an out-of-the-money option. And the model importantly has two central predictions. So first it's going to be that the demand for in-the-money options are going to be much higher for lower maturity options, and it's going to be much higher for lower volatility stocks. And so you can kind of see what the model predicts and in the simulation on the left. And then you can see on the right that this basically exactly matches the trading behavior through the kind of remarkable data collection that she has gone through. And that under certain sorts of conditions, this strategy, if you're strictly following the Kelly criterion, might be able to come up with some good.
Remind us, what is the Kelly criterion?
Do you want to, Stefan?
Yeah. So the Kelly criterion, it was first used for actually sports and casino bettings. And what it does is that different from just maximizing the expected return at just one time, it maximizes the logarithm of the growth of wealth in sequential bets. So that's the difference between like,
So it's fundamentally a betting strategy. It's like options are basically sizing your bets properly. And so I think basically this presents like a very neat kind of explanation for a couple of puzzles that we've seen in the kind of emergence of this in the money options trading market. So now turning to Jason's paper, and I'll kind of try to bring things together at the end. So Goldman Sachs has just released a report that shows that we're basically in the middle innings of this sports betting rise. And so I think they estimated it's forecasted to grow into a $45 billion industry. And I think naturally this is raising a lot of alarm bells and concerns. And so the National Council on Problem Gambling estimates that 2.5 million US adults are problem gamblers. And they mentioned that the kind of risk of addiction has increased 30% since this kind of 2018 SCOTUS ruling that started essentially to unleash this online sports betting phenomenon. And I think one additional piece of context that I think is really important to think hard about is that all of the developments in technology, the same kinds of things that you see in terms of kind of price discrimination and surveillance capitalism, if you will, is going to provide the potential to identify and exploit the people who might be susceptible to these kinds of problem gambling behaviors. That being said, there's a huge gap in evidence. Like I think before this paper, we had very little, I think, kind of economic empirical evidence to say anything very sharp about this. And so I think it's a really exciting place to be doing research. And so I won't belabor the econometrics, but they estimate a staggered difference in difference using the kind of dates of state legalization. They have transactions data for 230,000 households. And kind of credit card snapshots along with those, which include kind of credit limits and utilization, which is kind of neat. And what they see is basically a 10% increase in sports betting, $9 a month, $90 conditional on betting. I think the version of the paper I was looking at was a little bit out of date, I think, but this speaks exactly to this point, which is that it's increasing over time, and the estimates that I have now, I think, are twice as high as these. And so I think that's an important piece to keep in mind. And the average effects here actually were quite sanguine in my initial reading, which is basically that they see basically no increase in spending or a small increase in spending on things that are complementary to sports gambling. The decrease in investing is obviously not ideal, but there's basically no effect on credit card debt overall. And so I think my initial reaction was that the results actually don't look too bad if the consumption value of betting is high on average and people are really enjoying it. And then they kind of dig into this heterogeneity, looking at kind of the below median savings households based on the net flows. I think it would have been helpful to have a little bit more context on what the actual median is there as we're splitting these samples. So just to think about kind of how much excess capital they might have on hand every month. But for these folks, they're basically betting half as much on average. So the increase in betting is a lot smaller. And we're seeing just really huge outsized effects here, right? So the decline in investing is something like $41, the increase in spending is something like $59, and the increase in credit card debt is like $200. And this is coming off a much lower baseline, right? So we have the average monthly investment for these folks is something like $32, but it's declining by $41 on average. And so one thing I wanted to encourage the authors to do is spend a little bit more time helping us as the readers think through how we can reconcile these magnitudes given kind of a smaller first stage and the kind of lower baseline levels. And my sense is that they've already made a lot of progress on that, but I think kind of even further thinking in this direction could be productive. And so taking a step back, what is the key trade-off in kind of online sports betting? So we're trading off this public revenue and kind of any consumption value that we're getting versus kind of this problem gambling behavior, people who really get themselves into trouble. And so I think the heterogeneity results start to make some progress in this direction, but I think they can even do more here. So these initial results are kind of splitting by above below median. So they're still pretty broad-based, and I think actually really narrowing the focus here could be productive. We all know and are familiar with the Pareto principle, which is the vast majority of revenues are going to be drawn from a very small minority of households. I think this is true in like healthcare super utilizers. It's true in like online gaming spending, drinking, crime, drug use, sales of all kinds, right? And they show that the top tercile of bettors are depositing around $7,000 over the sample period. But the standard deviation of this is something like $20,000, right? And so, I'm not so concerned about the top tercile broadly, but I am, potentially very concerned about, the top, 5% or 1% of these gamblers. And so I think, more kind of forensic investigation in the direction of kind of trying to identify this problem gambling behavior, because that's really going to be the cost that we'll want to weigh as we're thinking through the kind of public policy implications of the results here. And so there seems to be a lot of disagreement in the kind of gambling literature that I tried to assess. It's like, it seems like basically that we have very little understanding of how frequent problem gambling is, how to identify it, the kind of data that we have available there. And I think the authors can, with very little, I think, additional effort, kind of make real contributions to actually understanding who is engaging in very problematic gambling behaviors. So I think, the rough estimates in those, in like gives more of a kind of public health literature is like some range between 5 and 50% of gamblers are problem gamblers. And so kind of thinking about, what is the actual distribution of betting deposits across individuals, conditional on participating and as a share of income. And kind of the new results seem to show some promising progress in this direction, but thinking about how much of the growth is driven by kind of within individual addiction development over time. And especially given this is a real short run kind of evaluation of this initial policy introduction, thinking about what that's going to mean 5, 10 years down the road. And I'll kind of provide a few more pieces of context on why I think that understanding that kind of within individual pattern over time is going to be important. Jason helpfully plotted this first stage graph, which shows that the kind of amount of betting expenses over time is increasing. And there's a kind of a nice complementary paper that came out around the same time as Jason and his co-author's paper, which looks at credit report records. So it's going to show kind of more of the liability side of these things, basically taking the same identification strategy. And here, I think some of the interesting patterns, like kind of looking at some of these more non-parametric event study estimates, is that a lot of these effects are going to emerge only over time. So 2, 3, 4 years down the line after the introductions of gambling. And so this one is showing the kind of increase in debt and collections. This one shows the kind of rise in bankruptcy filing. And that's only kind of happening 2, 3, 4 years down the line. And so all of these things collectively, I think, kind of made me think of this kind of broader societal conversation that I think has been emerging over the last couple of years. So this credit report paper found that the costs of sports betting are driven by young men in low-income counties. And as I kind of discussed at the top, Edna's paper is kind of describing some kind of gambling in the stock markets that is primarily being driven by a rise in gambling around young kind of young men in particular. And so I think Jason and his co-authors can, I think, do more about kind of really pinning down exactly where this problem gambling is happening, how we can identify it. But I think both papers tie into these kind of big picture challenges that are facing kind of young men right now, I think. So that reminded me of this Richard Reeves book that came out a year or two ago of Boys and Men. And there are many anecdotes you can pull from in that book, but the one that I find kind of particularly striking is that the 2020 decline in college enrollment was 7 times as large for men as women. And that's happening at the same time as this rise in sports gambling. It's happening at the same time as this kind of rise in options trading and gambling in the stock markets. And so this is like all very beyond the scope of the kind of 2 excellent papers that the presenters have put together. But I want to encourage myself and the authors and everybody in the audience to think hard about like what are the implications of this rising retail investment participation that is functionally gambling. Matt Levine's Money Stuff newsletter yesterday actually explicitly wrote about Jason and his co-author's paper in the context of Robinhood trying to pivot from a lot of these kind of options betting behaviors into kind of encouraging these kind of young men betting on options into kind of longer run index funds, and that being an actual important part of Robinhood's business strategy, so maybe they'll be the solution here. But I think more broadly, thinking about kind of what kind of consumer protections do we actually need in place. Online betting puts all of this at the kind of touch of a button in your pocket. It's like easily accessible. That seems to me to be kind of like particularly, makes this kind of addiction development that we already see when things like social media and people kind of like reaching for their phones for everything to be particularly potentially risky. But we do have some things that we are doing here. So you can think about, all of these places are using budgeting tools, like thinking about making those mandatory or something along those lines. And then thinking about which elements of this online sports gambling should be banned, whether we want to walk back some of the development. I think a lot of these betting apps are often offering like the worst of the worst possible sports bets. So it's like all kind of like same game parlays that like have particularly terrible odds. And so kind of thinking about how much do we want to kind of let the apps decide what kind of bets that they're really promoting, and do we want to think harder about how those things are actually being rolled out. But broadly, I had a really nice time thinking about both of these papers in conjunction, and thanks everyone for the opportunity to discuss them.
All right, so next we're going to have Gary Loveman joining us from Zoom.
Yeah, thanks, Larry. I should mention to those of you that I'm not acquainted with that I ran the world's largest gambling company for 20 years and ran the largest sports book in North America until such time as sports betting online was legalized. So I'm not exactly an impartial observer to the remarks that have been made by both authors and now most recently by Ray. And I'm glad that Ray spoke to one of the critical uniting features of these 2 pieces, and this is that the phenomenon studied by both authors are largely a study of the behavior of young men in recent years in a post-COVID environment when offered very innovative and very appealing new technologies that allow them to do things they consider to be fun very easily with scarcely any transaction costs. And not surprisingly, if a product that is compelling and appealing and can be done easily, conveniently at low cost, you're going to see a pretty big increase in the consumption of this. And the consumption is not uniform. The consumption is very heavily focused on young men. Women generally participate in very low levels in both of these activities, short duration in the money option purchases as well as sports betting. And not surprisingly, in the remarks that Jason gave about things like overdrafts and the effect on savings, you're talking about a group of folks that are not big savers to start with, who have 4 or 5 times the rate of overdrafts of their older colleagues under any circumstances. And not surprisingly, if they're also the largest user of this newly available technology and entertainment form, then you're going to see exactly the results that were described. So let me take a step back for a minute and just try to paint a quick picture. Jim Paterba and Nancy Rose and I have known each other for 40 years, and never once in that 40 years have I been invited over to their home on a Sunday afternoon. But let's imagine that this Sunday afternoon I am. and I joined them to watch the Patriots-Jets game. And the Patriots-Jets game is a pretty disappointing event because both teams are terrible, and no one, whether we're a Jets fan or a Patriots fan, has much hope for the prospects for either team. When we get together, Jim shares some funny adult stories from the NBER, and I share some funny adult stories from Las Vegas. But when we're finished with that, we have 3 or 4 things we could do. So we could make bets on the Patriots or the Jets using our app, online sports betting app, a DraftKings or a FanDuel, for example. We could order a movie and watch it together. Nancy might urge us to call DoorDash and order a bucket of wings with some beer. We might do that. Or we could decide to buy some in-the-money, short-duration options. Now, economists desperately want to view the first and the last of these through an investment lens. And you see both of these papers try to describe this phenomenon largely by young men, not Jim and myself, but young men, as investment decisions or on the margin of investment decisions. And I would argue strenuously they are not. No one believes these are investment decisions. The people who participate in them don't understand them as investment decisions. This is consumption. This is just the same as buying a bucket of wings. It's just the same as ordering a movie, buying into a streaming service, going out for dinner. It's an experience. What people are buying when they consume this is the thrill associated with the resolution of an uncertain outcome, and in both of these instances, typically uncertain outcomes that resolve rather quickly. One of the beauties of short duration in the money call options is that you know what the answer is pretty quickly. The same is true of most sports betting. Whereas if you buy an option to buy a stock 90 days from now because you're hedging a sophisticated portfolio problem, that's not really a gambling decision per se for a whole variety of reasons. So let me just share with you a little bit of data on both of these phenomenon. This has been covered briefly by both of the authors and a little bit by Ray, but just to make this clear, Sarah, if you can just pull this up. And the points about the in-the-money options I think have been covered pretty well, but if you could advance this, please. So let's take a look at Robinhood. In particular, look at the mean and median account balances of Robinhood. Robinhood is the dominant purveyor of the kind of options that Edna was describing. Note that the median account balance is $240 for Robinhood account holders, and the mean is $5,000. It's largely a male, young audience, and they constitute a significant portion of all options trading. Now, if you have $240 in your account and you want to trade options for whatever reason, what kind of options are you likely to trade? Are you going to buy a 90-day call option for some equity, or are you going to buy a short duration, low volatility option? I would suggest the latter, and that is exactly what we see happening here. Sarah, if you advance. We know that the trend in this market has been toward exceedingly short duration options. And if you advance it again, Sarah, you'll see that this is coincident with the arrival of COVID. And people very quickly started to trade exceedingly short duration options as their ability to do other things was sharply curtailed. If you advance this again. Now, finally, look at where these options are traded. They're traded on the most well-known, widely discussed equity issuers in the world. So not surprisingly, these investors, if you wish to call them investors, are buying stocks that they hear talked about all the time. And in the middle of the high cap stocks like Tesla, Nvidia, Apple, and Amazon, of course, is everyone's favorite meme stock, AMC. So if we turn now to the gambling side of this, sports betting is a very largely male business. It is in fact 90% male. Sports betting participation among women is de minimis. And if you take out certain novelty events like March Madness betting, sports betting participation among women is very low. So whatever your societal concerns are about the growth of sports betting, this is largely an issue that is focused on the participation by men and very heavily by young men. The participation rates across income groups, however, are very different. It is to some degree a luxury good in the sense that people who have more disposable income may participate in this more than you would think. Sarah, if you advance this a little bit further. This is also not disproportionately focused on people with low levels of education. This is the same thing that's true of casino gambling broadly. People participate in this for a variety of reasons, and it's not sharply linked to educational attainment. And Sarah, one more. The average size of bets in sports betting are modest, $61 bet, and 50% of all bets are under $10. Now, let's just talk for a moment about the composition of these bets. I ran casinos where people were largely betting against the house. As you all know, that's not what sports wagering is about. Jim and I are meeting this coming Sunday in his home. He's fond of the Jets. I'm fond of the Patriots. Nancy's fond of the Jets. It turns out Nancy is a hard line money line and spread better. Jim fancies himself a parlay and proposition gambler. So Nancy wants to bet against me, a Patriot supporter, on the spread. Jim wants to bet on whether the person who scores the first touchdown wears an odd or an even numbered jersey. All of this is made commercial through the charging of a fee. So people are paying a commission for this. There's a counterparty on the other side of all of these wagers, and the sports wagering business is very good at balancing both sides of these wagers. They're not betting against the house. So this is very much like Edna's in the money option business, where people are paying for the right to place these bets, either through holding their balances or through a commission if there is one, but they're not making principal bets against the house. And the cost of these, as you undoubtedly know, is very low. Okay, Sarah, I think does that conclude these slides? Okay. So what do we make of this? So Edna does a very nice job of formalizing the rise of these forms of options and asks what could be driving this. And she questions, is this a gambling behavior when people undertake these forms of options? And she has a very elegant way of trying to demonstrate it through a model that's been around for some time. I think the answer is undoubtedly yes. If you look at who is the customer, what are they doing, how are they doing it, what type of option purchases are they making, and what's influencing those purchases, this is certainly gambling, and gambling in this instance is consumption. The same thing applies in sports wagering. I would just remind Jason in particular that if I start a business and I hope to be successful at it, and I introduce a new concept to the commercial audience, I am hoping to displace something. Somebody has to be displaced. Now, I think Jason would feel a lot better if the displacement came on the part of some other consumption activity that the purchaser was displacing, for example, trips to restaurants or bars, rather than having it fall on savings. But let me remind you that young men are not particularly good savers to start with. So it's not terribly surprising that if you introduce something to them that they find very amusing and fun, because it is a lot of fun. I mean, you'll see this Sunday, Nancy and Jim and I will have a ball on a game that is otherwise completely meaningless, that has no consequence for the future of the NFL playoffs, because we can make all these silly wagers, and we can do it at very modest stakes, and we can do it very easily with the touch of a button. That is just consumption. Now, Jason would rather that we displace some other form of consumption rather than displace our savings. But this is a little bit of an odd argument for an economist. My sense when I was trained at MIT in economics is that we allow consumers to make decisions based on the allocation of resources between current consumption and future consumption, and their discount rate helps to mediate this. Here's a bolt of lightning about young men. They have very high discount rates. So they decide to consume a lot now, they postpone consideration for what they will consume later. Is it our job to intervene and tell them that that's wrong and that we should stop them from doing that? Well, let's suppose that Ray and Jason argue that we should, because I certainly get the impression they'd like to. Then let's look at all the things that young men are consuming. Now, let me warn you, this is not something that children ought to look at. This is adult content. What are young men consuming? They're consuming a lot of things that aren't great. Which of these would you like to tell them to stop? Would you like to tell them to stop eating badly? I'm in healthcare now. I would argue that the damage from their dietary habits might be far greater than the damage from their online sports wagering habits. Would you rather that they stop traveling? What would you like them to stop in order to create more space for savings? And under what authority would you argue that whoever we are here, the economists of the world or the social policy interveners of the world are going to legislate how those decisions ought to be made. Remember that I and a lot of other people spent a very long time trying to convince politicians that it should be okay for people to bet on sports outside of Nevada and New Jersey. And over a very, very long deliberative process, that decision was made in many states, but though certainly not all, not yet in California, not yet in Texas, for example. And what we've discovered is that the rate of addiction among players is not nearly what Ray quoted. It's something in the neighborhood of 3 to 5%. And it's not the same people all the time. It's a transitory circumstance that's been studied now since the late 1940s and studied best not by economists, but by psychiatrists and others who are expert in the field of addictions. And there are a variety of things that one can do to remedy that. The question is that what the answer here ought to be if what you want to do is improve the savings rate of people who save very little already and you want to ask them to save a little more early in their life? What should be the method to do that? I would argue that that is not to constrain their ability to make consumption decisions, but rather, if you wish to motivate them to do something else, then modify the terms under which they make those allocation decisions. So Larry, I'll pause there.
All right, well, thank you very much. So before we open it up for questions, I know sometimes the NBR has a rule about not responding to discussants, but I did want to give Jim an opportunity to respond if he wants to let us know about his preferred parlay bets, and then we can go in with Q&A.
Gary, if you can hear me, I'm going to be emailing you tonight for a little guidance on which side of the line I want to be on.
Excellent. With that, let's go ahead and open it up for Q&A.
I'm far from an expert on this, but as an avid consumer of sports, I had this, especially European sports, my impression is that actually in Europe, this sort of sports gambling has sort of been ahead of the US in terms of how widespread it's been. I think the Premier League, like half of the teams have sports betting companies as their main sponsors on their shirts. And then now this has sort of led to some backlash and actually some proposals for restricting this in the UK. So I was wondering if you've thought about kind of the international comparisons as maybe offering some guidance for what's going to happen in the US.
It's a great question. I mean, our data is only US data, so we can't speak directly from our data to other countries. And I have not seen research on sort of the financial harms, if there are any, in the context of European betting. But my guess would be that the sort of negative consequences to sort of long-term savings are likely to be present across all settings.
You've got a question here, and then Jonathan.
Thank you so much. My name is Irina Vodenska. I'm from Boston University. And I have a couple of questions. Thanks for this enlightening talks, basically, which made me think about two aspects of how we might think about this phenomenon of this option investing and also betting. One is you showed that this is really detrimental to savings, especially for the lower income brackets and people who might be maybe it's not the best word, but desperate to attain the American dream. And this is a way to try to get ahead of the curve. So it brings me to the point of inequality and the rising inequality and the increasing of the gap between people who can afford the American dream and people who cannot, and especially with the future generations. So I wanted to hear your take on that, and as an aspect of considering curbing what is currently happening, especially with the younger people. And second one is, I was really struck by the fact that when you get together with friends and you have some fun things to do. One is betting on the game you're watching, maybe ordering some food, but it's not that exciting to save, to make a savings decision at that time. So maybe we should make some changes in finance education, or even making it more fun for young people when they get together to get some points in whatever they can bet, or they can compete against each other, who will get more points in that savings decisions, to make it more fun to do something like that when they get together, and then that fun level can compete with betting.
I fully think it's a reasonable suggestion to, could you gamify savings in a way that could result in good behavior? Tony Cookson has a paper that suggests adding gambling or lottery-like prizes to savings accounts actually increases savings, so I think there's room there to iterate on that for sure. To your first question, I think this does likely impact inequality. I'm sympathetic to Gary's point that I don't think most people are viewing this actively as I'm going to sort of gamble for resurrection, or I'm trying to win big for a savings purpose. I do think this is mostly just consumption. It's fun consumption, but because it's so fun, it crowds out the less fun activities like planning future consumption.
So if I may, just let me say one quick thing. If you look at the activity of young men with respect to things like preventative health care, you find that the take-up rate on almost anything that is offered to young men, young women, and older women with respect to care for their health and preventative measures for their health, the lowest uptake rate is among young men. And I wasn't joking when I said that overcoming a very high discount rate among young men is a real challenge in a lot of areas. And this applies here as well. My other question for Jason, however, is what if you did an equivalent study on things like Worlds of Warcraft, and you looked at the resources that young men have devoted to things like incremental purchases on games that don't involve gambling, but involve online activity? Or if you looked at the rise of multiple streaming subscriptions. My hunch is that you would find displacement of savings on almost every one of these instances. And the question then would be, what would you make of that? And if you were to find this kind of activity associated with any number of other discretionary activities concentrated among young men, what would you argue would be the policy prescriptions for all of these?
Yeah, it's a fair question, Gary. I think it would be great to look at other kinds of spending and how it crowds out or not, say, savings decisions. The nice thing about sports betting is we've got a discrete point in time where it's legalized, and so it's easier to identify the effects than it is for whatever, a streaming service purchase or something. So I can't speak with any degree of certainty, but my hunch is that there are aspects of sports betting that are likely to be different than other consumption in the following sense. Maybe addicting is too strong perhaps, but there's something about the utility that you get from sports betting that I think has a bigger pull than many types of consumption. And so my guess is that it pulls people in longer and deeper than many types of consumption. You see some evidence of that in that the betting behavior is sort of ramped up over time. It's very persistent, but not only persistent, increasing over time. Those are the aspects that I think we ought to be aware of. But I mean, to your bigger point, I would not argue, my co-authors would not argue that we should get rid of sports betting, but more that policymakers ought to be thinking about these concerns as we discuss sort of what is the right approach to allowing for people to have the entertainment value of sports betting, but protecting the most vulnerable households at the same time.
And I just want to quickly add to the second question. I think that gamification in these platforms actually they have increased trading on specifically for stocks and options on Robinhood, TD Ameritrade. There's a paper of Mariana Capco and Marius Ocain where they talked about this gamification, and yeah, it is true. This actually it's fun if you see confetti after you make a trade, or something like this. It actually increases retail trading on these platforms. It's definitely something that maybe we could add to the savings. Yeah, why not?
All right, now we've got a couple questions in the darker side of the room.
So this, I would just say that when Jim and I get together in Belmont, we do talk about 401k savings. So
Agreed.
Nancy's a lot more fun than you.
We usually do antitrust with her. So I have sort of the point that these are two very different environments, the online sports betting and the retail option trading, and they're very different in a regulatory perspective. So they may be entirely consumption and entirely investment, but to the extent that they overlap, it is strange how incredibly differently we think about regulating them. So the idea that Robinhood has confetti with the purchase of a short-term out-of-the-money option when it wins, and that might be a problem, whereas an online sports book is going to have all sorts of advertising associated with it and celebrate the victory very differently. And in fact, there's sort of already a built-in team celebration often going on at the same time, or they're very similar and yet regulated not to compete in any way. The other comment I'll make is that whether this happens, I would have said it's much better to have the addictive gambler or the high-use gambler gambling in stocks which pay a dividend rather than in zero-sum bets with a bid-ask spread taken by the casino or the online sports book. But they actually are now distorting sort of the allocation of capital. So having the gamblers not in the option market and moving around prices and making them less informative and misallocating capital in the economy, but having them do it in the sports book setting just against each other with a small bid-ask spread is maybe socially useful from a capital allocation standpoint.
Yep. So just answering to that, so part of like the stocks and how they, like this betting can influence the stock prices. Like I think that's definitely one of the things that like for future work I would like to see specifically how option trading affects the stocks. So I have another paper where I look at how like stocks that are very popular on social media affects prices, but like on the equity side. And one of the things that we found is that it deteriorates the price efficiency of the stock prices before earnings announcements. So there's actually a negative impact. And that after the earnings announcement is disclosed, like the market corrects the price, but before that, there's actually a deterioration of the price efficiency. So yes, you're right. At least for the equity, like there's this like paper that I already have. But then for the options, like this is something that I would like to future look at.
Yeah, hi, sorry. I just have a question about the option betting paper, which is that the definition of who is a retail trader is based upon the quantity of options in each transaction, right? If it's under 100 options for each trade, then that's a retail trader. But for the rest of the paper, sort of the definition of the size of position is measured in terms of dollar terms of the option purchases. And I'm wondering if that's a bit inconsistent. And in particular, what I'm thinking about is that in-the-money options are generally more expensive than out-of-the-money options. So say you were to spend $10,000 on expensive in-the-money options, which say costs $200 each, then you've bought 50 options, and that does not make you not a retail trader. But if you spend $10,000, the exact same amount of money, on cheap out-of-the-money options, which are say $50 a contract, then you've bought 200 options and you're no longer classified as a retail trader. And I'm wondering if this sort of distorts the statistics and then it overstates the extent to which retail traders are buying in-the-money options. Thank you.
So this is a very good question. I feel that the data that I have of the options data, unfortunately, like they do the classification. I'm not the one that I'm doing it. It's just like it comes with the exchange. So I cannot, like it will be amazing to do the classification in terms of dollars, in terms of contracts. But one of the things that I try to address this limitation is to use like social media data to show that indeed when there's like more activity on social media data of these retail investors, like I see like more trading volume from the options market. But I agree, like there's on the other thing that you mentioned, then At the end, in the money options are like pricier than out of the money, but still I feel that just not because they're like pricey, like it's very important to see like where really like the dollar or the wealth of these investors goes to, rather than just like a number of contracts, like really to see where do they invest in dollar terms, but like in the money versus out of the money.
Larry, I know you're out of time, but can I have 30 seconds?
Go for it.
So late in my tenure at Caesars, I was told that Larry Summers was coming to Las Vegas. And by this time, Larry had been the Treasury Secretary, the chair of the Economic Council, and the president of Harvard. And when I welcomed Larry to my office, I learned it was the first time that he had ever been to Las Vegas. And he was visiting on behalf of NASDAQ, and we were a NASDAQ-listed company. So we had a lovely chat, and I learned that it was his first visit, which I found quite extraordinary, given that by then he had run the U.S. economy and a number of other sovereign entities. And we took a chat and took a walk down to the casino floor, and I walked him around a bit and showed him what was going on. And he really did look like a fish who sees a bicycle for the first time. For whatever reason, gambling is a real bugaboo to economists. Yeah, remember that these same young men that are getting on a sports betting site are also being asked to take credit from banks at usurious interest rates. They're being asked to eat triple Whopper burgers. They're being asked to buy premium gasoline when their car only needs regular, and so on and so on and so on. There's all kinds of things that they're being asked to consider. Very few of them are in fact addicted, although economists run to the notion that almost everybody is addicted to this activity and not to so many others, and then decide that what we have to do is intervene here. I would just encourage all of us who are interested in this field to take a look at the wide range of things that people spend their money on and decide among all of these things, many of which you might judge to be relatively poor uses of their money, which one would require some sort of policy remedy. Thanks, Larry.
All right, well, with that, we'll take another break.